Hi, my dear CA final students. I'll not call you students anymore. You're warriors. Because after writing the CA final exam, that too IBS, so really, like a war only you have went. Because I have seen many Instagram photos of many students they have shared, like they were carrying a lot of books, big, big suitcases, and all they were taking for the exam. And thereafter, after coming out of the exam hall, also they have given their reaction that what they have taken they could not make best use out of it. It is like, you carry many weapons but you don't know which weapon to use in the war. So like that it has happened. So even I suggested to some students to carry this 50 case study book, which ICA has published recently. But to the surprise, so students said that not many questions came, like not even one or two sir case studies. So entire 50 case studies also we have gone through, but we could not find any question, related question, except for one or two questions only we could see. Not one or two case studies, one or two questions only we could see, like that they have shared. So therefore really great year. So this IBS paper even I have gone through, and it was really difficult. It's not that easy. So because I know in indirect tax portion, so right now I'm confining my discussion only to indirect taxes. So because we have other subjects as well in that, but I am not going to speak about that. But overall view what I have seen is that really the paper is very, 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 very difficult. Okay, so even if you have book also, unless you have the knowledge of the subject, you will not be able to do. Because now especially these indirect tax related questions, so much tricky, it's not that easy. And if paper 5 what they have given indirect taxes is like somewhere 9 out of 10 in the difficulty, so this paper will be like 10 out of 10 difficulty, like that they have given. So it's not that easy. Unless you have complete knowledge of the subject, you will not be able to cope up with that. Okay, so without further delay, let's move on to the discussion related to this indirect tax portion in IBS paper. Okay, so this is case study 1. In this case study 1 they have given lot of transactions, lot of issues, like multiple chartered accountants are there, and they have got article students, and these article students will be assisting those chartered accountants in that. So in that there is one issue related to this machine. 3 machines are purchased by the company in the month of March 2024. In these 3 machines, machine X, which is used exclusively for taxable, as it is used exclusively for taxable, so ITC can be availed with respect to this mission X, whereas with respect to mission Y it is used partly for taxable and partly for exempted. So we can avail ITC with respect to this mission Y also. But mission Y will be called as common ITC, because we cannot enjoy the ITC fully, so we have to do the proportionate reversal. Whereas mission Z, if you see, mission Z is exclusively used for exempted, means we cannot take ITC with respect to mission Z. So ITC not available with respect to mission Z. Mission Y ITC available, mission X also ITC available. And what is the question? So they are asking one question related to this, that is there here. Theory question they have asked, I think case study 1.8. Yes, so 1.8 question: advise the correct treatment of IGST paid on purchase of machines by HCP Limited in GSTR 3B to be filed for the month of March 2024 as per the relevant provisions of CGST Act. So how much is the ITC availed in GSTR 3B? With respect to both mission X and mission Y, they can avail ITC 9 lakhs and 10 lakh 80,000. So that is 19 lakh 80,000 is the ITC availed in GSTR 3B, and thereafter we need to apply rule 43. So what does rule 43 says? Rule 43 says that we cannot enjoy the full ITC, so we need to do the proportionate reversal. So we need to first take the total ITC divided by 60 months, because the life of the capital goods, this is missionary na, the life of the capital goods will be considered as 60 months from the date of invoice. So accordingly total ITC is 9 lakhs plus 10 lakh 80,000, 19 lakh 80,000 divided by 60 months into what is the exempted turnover to total turnover for this month. So all these transactions pertains to March 2024 only. For March 2024, taxable supplies and exempted supplies 1,500 and 300 respectively, which means that what we need to do, so this 300 whatever is there is the exempted divided by the total. So 300 plus 1,500, that is 1,800. So 10 lakh 80,000 divided by 60 into 3,000 by 1,800, 3,000 rupees is the ITC reverse. So ITC availed is 19 lakh 80,000 and ITC reversed will be 3,000. So that's where 19 lakh 77,000 is a net eligible ITC. So this information we need to write. That is the answer for the first part of the question. So 1.8 A, 3 marks. Then another one you can see, So this B with reference to the goods sent outside India by HCP Limited, because in this question they have given one paragraph, we will read that paragraph. They have sent the goods outside India for a purpose of exhibition. You are required to answer the following with explanation of relevant provisions. When is the supply of goods sent outside India said to take place? Whether invoice is required to be issued by HCP Limited in respect of the goods not brought back. Whether refund can be preferred by HCP Limited in respect of goods sent outside India but not brought back. So this is one 3 marks part. So here let's read the relevant paragraph related to this. So you can see here, company sent 600 units of goods outside India for exhibition. We all know that whenever the goods are sent outside India for exhibition, it is not a supply. So because it will not come under 7 subsection 1 A, B, C anywhere. Okay, 7 1 A, B or C. So consequently it is not a supply, and we also have a CBIC circular which says that whenever goods sent outside India, even though it is export per se as per the definition, but as it is not a supply, it will not come under zero rated supply. So when the goods are sent outside India for exhibition, it is not a zero rated supply. Consequently, so we don't have to claim refund and we cannot issue invoice. But they have connected in the circular with 31 subsection 7, sale on approval or on return basis. So when the goods are sent outside India for exhibition and not brought back within 6 months from the date it has been removed, or the date of acceptance, whichever is earlier is the due date of invoice for sale on approval or on return basis. But applying that 6 months logic, if the goods are not brought back within 6 months from the date of removal or date of export in this case, then we have to deem it as supply and we need to raise the invoice in terms of 31 subsection 7. Here if you see 600 units, these 600 units are sent on 1/9/2023. So 1/9/2023, 6 months if you see na, so that is 1 10 11 12 1 2 3 by 1st March. Okay, 400 units were brought back on 20th February, means within 6 months 400 units came back. So at the time when we are sending 600 units, invoice is not required because it is under the cover of a delivery challan, properly they did. And within 6 months from the date of removal, 400 units are brought back to India. So there is no consequence with respect to this. But remaining 200 units. So 200 units were not returned till 31st March, means it is deemed to be supplied. So when is it deemed to be supplied? As on 1st March, it is deemed to be supplied and we need to raise invoice, and accordingly on the basis of this invoice can we claim refund? Yes, in case of export of goods, section 16 says that we can claim refund under any of these two options, that is pay IGST and get refund, or export without payment of IGST and get refund of ITC, like that. Okay, so they can claim refund, but we have a condition that they should ensure that the proceeds should be realized within the time limit under FEMA, so which is 9 months from the date of export. So otherwise, what if the proceeds are not realized within the time limit under FEMA, whatever refund that they have claimed will become payable along with interest if they voluntarily pay. If it is recovered in terms of 73 74, then even penalty also will be applicable. So this information we need to write, that is for 3 marks. Then next there is another question, one MCQ is also there in this case study 1. So that MCQ is related to due date of invoice in case of sale on approval or on return basis. You can see here, company has supplied goods on delivery challan for rupees 5 lakhs on approval for sale or return basis to DEF and company on 1/3/2024 with the option of returning within 60 days. DEF Limited signifies his approval for the whole of the above mentioned goods on 15/5/2024. So what is the due date of invoice as per section 31 subsection 7? It is 6 months from the date of removal. So 6 months from the date of removal, 1st March, you can take, that is April, May, June, July, August, September. So 1st September, or date of acceptance by the recipient, that is 15/5, whichever is earlier. So whichever is earlier is 15/5. So this 60 days point is irrelevant. Actually that is for confusing you. So but we need to take 6 months from date of removal or date of acceptance, whichever is earlier. So 15/5/2024, because we have one MCQ related to that. You can see which of the following options correctly state the date of issue of invoice in case of goods sent on sale or return basis. So 6 months 19, date of acceptance 15/5. So whichever is earlier, option A 15/5/2024. So literally it's like 6 plus 2 8 marks they have given in case study 1 related to indirect tax. Then next one, I think yes, these are the only questions we have in case study 1 related to IDT. Then case study 2, in this case study 2 they have given 2 MCQs only, so related to indirect tax. So weightage is only 4 marks, and we will read this paragraph first. This is related to TDS point, that too they connected this TDS point with income tax also. So this particular company is generating some power and they are selling that power to KSEB. KSEB is a Kerala State Electricity Board, so which will be coming under person for the purpose of deducting TDS under section 51 of CGST Act. So after getting required approvals, officials of KSEB required a purchase order and entered into contract with GL for supply of 20 lakh units of product with a total supply value of 20 crores. 20 crores means as a value of supply, a contract value of supply exceed 2,50,000. So definitely TDS will be applicable in this case. And that too before the deadline, KSEB withheld 2 crores which is payable after 12 months and paid the balance after deducting TDS under Income Tax Act and GST. So now they are asking how much will be the applicable TDS. See, you have to know this. This is what I told you. ICA has really went so micro level and they are testing. Usually we know that 2% is the rate of TDS that is applicable. So 2% we will apply. But 2% on what? Is it on 20 crores or 18 crores? Because they are not remitting 20 crores. They are remitting only 18 crores because they retain 2 crores. So in that case, whether it is 20 into 2, 40 lakhs, or is it 18 into 2%, 36 lakhs. Actually, if you see, the wording given in section 51 is TDS under section 51 on payment made or credited to supplier. That is a line given. So we need to compute TDS at the rate. So if it is CGST 1%, then SGST 1%. If it is total 2%, 2% on what? On the payment made or credited to the supplier. What is the payment made or credited to the supplier? Here it is only 18 crores. So which means 18 crores into 2%, 36 lakhs only. And while computing GST, TDS, we don't have to include income tax, etc. It should be taken on the payment made or credited to supplier. So 36 lakhs. Whereas in case of income tax actually is not like that. Income tax, I think it is on the contract, okay, contract value. So 20 crores into, so 2%, they're also 2% only, so that will be coming to 40 lakhs. But fine, about GST I'm talking, so 36 lakhs will be taken as the answer in this case. So it should not be 40 lakhs, keep that in mind, okay. So this definitely, I know many students message me stating that sir, we took 40 lakhs, is it correct? No, sorry, it is not correct answer. It should be taken as only 36 lakhs, okay. So if you want, you can refer to section 51, you will understand better related to this. So that is this. How much is the amount that would have been deducted by KSEB as TDS under Income Tax Act under GST law? So actually it is 36 lakhs under GST. Option B, 36 lakhs under IGST Act should be taken. That is the correct answer. Of course, 40 lakhs is what I heard. So under income tax, so 40 lakhs under income tax, 36 lakhs under IGST Act. Got it? Then there is one more question related to the descriptive part. Okay, so here it is only one MCQ 2 marks. Then again descriptive part 5 marks is there. So good 7 marks they have asked related to indirect taxes. So this part is related to one small paragraph. So paragraph and small paragraph they have given, and on that only they are asking the question. While implementing new technology, GL availed the technical service of Mark Limited UK on 20th December 2023, who raised the invoice for GBP 1 lakh on 28th December 2023. GL made payment on 22nd January 2024. So what should be taken as the supply in this case? So it's an import of service because supplier is located outside the Mark Limited and recipient is located in India. So it's an import of service for consideration whether or not in the course or furtherance of business it constitutes supply under 71B. That's the first part you need to write. Then you need to talk about whether it is taxable or exempted. It is taxable because it is not covered under anywhere in the exemption, so it is taxable. Then who is liable to pay GST in this case? We know that in case of import of services, the liability to pay GST is on recipient. Only in case of OIDR service, it is some other case, that is supplier, but here it is not a OIDR service, therefore it is the recipient who is liable to pay GST under RCM as per 9(3) read with notification 13 of 2017. And the next part that we need to write here is that as to what is the time of supply, because if you see the question you will understand they are not only asking do you think that the transaction between GL and Mark attracts any GST under Goods and Services Tax Act? Yes, it attracts, but if yes, then who has to deposit GST? So RCM point we need to write, and in which month. So they're asking time of supply. So time of supply, for that they have given the dates also. So we can see there. So time of supply is as per section 13 subsection 3. As per 13 subsection 3, we need to take date on which payment is made to supplier or 61st day from the date of invoice. What is the date on which payment is made? Payment is made on 22nd January, and 61st day from the date of invoice will be definitely later only because 20th December is the date of invoice, I think. Yes, no, 28th December. So definitely whichever is earlier, will be 22nd January 2024. So that will be taken as the time of supply in this case. So based on this, we need to write that is 61st day from the date of invoice, or date on which payment is made to supplier, whichever is earlier. The provision we need to write, and you need to answer the 22nd January 2024 is the time limit for time of supply, but the due date will be next month 20th. So next month 20th means 20th of February, because they are asking who has to deposit and in which month. So they have to deposit in January month and by 20th of February. So those points. And remaining and all not related to GST, everything is related to other subjects. So by good. So in case study 1, they have given for some 8 marks and then 7 marks. Then in case study number 3, so there is one part which is related to computation of customs duty payable. You can see here, Maximo Limited imported new machines from USA by air on CAF basis for US dollar 1 lakh. The air freight was US dollar 12,000, insurance US dollar 8,000. Later, it negotiated the price again with the supplier, and the renegotiated price was fixed at 95,000 US dollars. The exchange rate on the date of bill of entry is 25/6 was 1 US dollar 84, and on the date of arrival of aircraft was 1 US dollar 82. Both the exchange rates are notified by CBIC, and basic customs duty rate is given. There is no change in social welfare surcharge between the date of filing bill of entry and the date of arrival of the aircraft. Fine. Based on this, actually they are asking how much is the customs duty payable. First we need to see what is the CIF price. CIF price as per section 14 of Customs Act, we need to take the price prevailing at the time and place of importation. What is the price prevailing at the time and place of importation? It's not $1 lakh, it is $95,000, because whenever there is a negotiation happen, so even though the contract price is $1 lakh, but actually what they are paying is only $95,000, because we need to take the price prevailing at the time and place of importation. So due to that reason, $95,000 will be taken as the CIF price. Negotiated price is the CIF price as per section 14. So $95,000, and thereafter freight and insurance needs to be reduced. Why? Because they gave air freight. Air freight should be restricted to 20% of FOB due to that reason. So minus freight and insurance $20,000. So we get the FOB price as 75,000. So now what is taken as the exchange rate in this case? If you see here, the relevant exchange rate will be bill of entry date only. So that is as on 25/6. As on 25/6, because that is the bill of entry date, it was 84 rupees per dollar. So we need to multiply with 84. So 75,000 into 84. So that will come to 63 lakhs. So 63 lakhs will be taken as FOB price, and after this we need to take air freight. So how much will be taken as air freight? Air freight will be actual or 20% of FOB, whichever is lower. So FOB is 75,000. So 75,000 into 20%. So is what? $15,000. Whereas the actual air freight is only $12,000. So we'll take $12,000 only. So $12,000, and that needs to be multiplied with 84. And then insurance should be taken as actuals. And what is that insurance actuals? That is $8,000, again no change. So 84 rupees will be taken. Now this will be your assessable value, because we don't have any other information. So we need to take 12,000 into 84. 84 is only the correct answer, because we need to take on bill of entry. So 10 lakh 8,000, and then 8,000 into 84. So that will be coming to 6 lakh 72,000. So total, if you see, 63 lakhs plus 10 lakh 8,000 plus 6 lakh 72,000. So that will come to 79 lakh 80,000. That is the assessable value. So assessable value. Then we need to compute the customs duty. What is the relevant date for determination of customs duty rate? Date of presentation of bill of entry or arrival of aircraft, whichever is later. So 25/6 or 7/7/2023, whichever is later is 7/7. As on 7/7, 10% is there. So 10% should be taken. 79 lakh 80,000 into 10%. So that will come to basic customs duty, that is 7 lakh 98,000. So 7 lakh 98,000, social for surcharge always 10%. So therefore we need to take social for surcharge 10%. Then we will get 8 lakh 77,800. And we don't have any information about the IGST here. So as there is no information about IGST, we will be taking this much only as the customs duty. So therefore the answer is 8,77,800 we got. Okay, so 8,77,800 will be taken as customs duty payable. That's a 2 marks part. Then there is one more paragraph related to the penalties. So see this, Maximo Limited having its manufacturing and distribution plant in Thane, Maharashtra. Actually, this place I wanted to add one point, because the 73 related penalty already they tested in paper 5 also, indirect tax paper also. And again, the next exam itself they have given. So at least by this time, the student should have realized. So sometimes it will be good so to know what is the question paper immediately after. So what I did is that I could not make the video because of the constraints what I had. I was traveling. So but immediately I posted after the exam itself as to MCQ answers for paper 5 in my Telegram group. Okay, immediately, like within 45 minutes after the exam got over, I have posted that as to what are all the answers for that. It is there in that, and anyhow that video is also there, you can check that. So Maximo Limited, having its manufacturing and distribution plant in Thane, Maharashtra, has in the month of November 2023 collected GST at a rate lower than what is prescribed in law. So they collected lesser tax. Thus there was an error in collection and remittance of GST. Yes, this is called as short payment of GST. Okay, short levy, and that short levy resulted in short payment. A show cause notice was issued under 73, so they invoked 73. The moment they invoked 73, penalty will come. What is the penalty? 10% of tax not paid, or 10,000, whichever is higher, that is under CGST, and the same amount will be payable under SGST. Okay, so for payment of tax of 6 lakhs and interest amounting to 1,08,000, Maximo Limited is aware that the short collection and short payment of output tax by it neither paid the GST tax demand in response to the show cause notice nor offered any explanation for the same within 30 days from show cause notice. This is not a self-assessed tax. This is like self-assessed tax means should be reported in GSTR1. They have not reported in GSTR1. It is not a self-assessed tax. Normal delay in payment of tax. In this case, when they give the notice, we have the benefit of reduced penalty or no penalty. That is, if the payment is made before show cause notice, there is no penalty. Or if the payment is made within 30 days from show cause notice, also there is no penalty. Otherwise, we need to pay the penalty, normal penalty that is payable in terms of 73. But this benefit is not applicable in case of self-assessed tax. That part only tested in paper 5. That is in indirect tax 1 MCQ. So here it is normal due. It is not self-assessed tax. So it is like arrears of tax. In that case, 10% should be taken as a penalty. So 6 lakhs into 10%, 60,000, or that is we have to divide the 6 lakhs into two parts. 3 lakhs, 3 lakhs, 3 lakhs into 10%, 30,000 or 10,000, whichever is higher, 30,000. Then again 30,000 under SGST. So the total penalty will be 60,000. Suppose if they ask 30,000, 60,000, that would be a confusion. But don't worry, they have not given those options. They are asking 10,000, 60,000 like that only. The correct answer in this case is 60,000. So the penalty cannot be waived off in this case. So 60,000 is the correct answer. How much is the quantum of penalty leviable on Maximo for not paying the GST due or offer explanation in response to the show cause notice? So 60,000 should be taken as the answer in this case. 10,000 is not correct. Actually, to confuse you, they could give 30,000 or 60,000. But as per CGST Act, like that they have asked, then only it is 30,000. If it is total penalty, then it will be 60,000 only. So in this, only two questions. So like hardly 4 marks only in case study 3. Then in case study 4, they have given very good point related to transfer of ITC on account of separate registration which is being taken, like that. That is transfer of business. So whenever there is a transfer of business, so we can transfer the ITC. So for that reason, that to demerger, like that, when it is given, we need to transfer based on assets ratio. Okay. So here if you see this question, basically I'll tell you, there is one company and then they created another company. So this company, one division, one shop is being transferred to other division. MPL opened 25 stores throughout India and earned net profit before tax of 6 crores for financial year 23-24. The EBITDA for the same period was 9 crores. Actually, that is irrelevant for GST, and interest paid was 2.8 crores. For the same period, profit after tax 4.5 crores. WMPL, that was the another company, has decided to open new store in Pune in April 2024. Land was purchased and establishment work was completed. separate GST registration for Pune was taken in April 2024 and stock purchase for new store has also been done. The following further details were available on the date of registration. Here what happened is that this is the value of the entire business. Out of this entire business, so one unit has been transferred, okay, one division has been transferred, that Pune division. As per the management projections, the new store at Pune will achieve good sales, and accordingly it was decided to transfer some part of GST credit outstanding in the electronic credit ledger to electronic credit ledger of separate Pune registration. Accounts department has drafted a letter stating that 2.5 crores can be transferred. So we need to understand here how much can be transferred. What is the credit that is available? Unutilized ITC 25 crores. So 25 crores can be transferred. Okay. So 25 crores can be transferred into what is the assets of Pune. What is the assets of Pune? Fixed assets, current assets, total assets ratio. Value of assets on which ITC has been taken out of fixed assets and current assets reported above. So you don't have to take this 40/160 ratio. You need to take 22 and 50. So what is 22 and 50? 72 divided by what is the total? 900. Okay. So out of that 900, 72 lakhs of assets is being demerged or spin off. So to that extent, the ITC can be transferred. So therefore, 25 into 72 by 100. So what is the answer? 25 into 72 divided by 900, that will be 2. Okay. So 72 by 900 into 25. So 2 crores. 2 crores can be transferred, but they are telling 2.5 crores can be transferred. Related to this, there is one MCQ. What will be your comments on that draft letter of accounts department stating that GST input tax rate of 2.5 crores can be transferred? So the amount calculated is incorrect, as the amount which can be transferred to Pune registration is only 2 crores. So option B is the answer for this. It's a very good question. Actually, good thought, and I have coined this question. Then there is one more which is a descriptive question, but actually this descriptive question don't have any paragraph to be read here. Accounts department of WMPL is filing GSTR 3B for the month of September 2024, wherein total taxable supplies reported are 50 crores with output GST liability of 6.25 crores. Input tax credit available in electronic credit ledger is 7.5 crores. So 6.25 crores is their liability, and they have sufficient balance in the electronic credit ledger, and balance in electronic credit ledger, cash ledger, is 75 lakhs. Whether WMPL is mandatorily required to utilize the balance in electronic cash ledger while paying GST liability for the month of September 2024. Also state the nature of documents on the basis of which ITC would have been taken by WMPL. There are two questions. First question, can they use entire balance in credit ledger for payment of liability? And the second question, what are the documents on the basis of which ITC can be availed? So first part we will see. So here the taxable turnover exceeds 50 lakhs. Definitely rule 86B will be attracted. When rule 86B is attracted, they cannot utilize the entire balance in credit ledger for payment of the liability. So they have to pay 1% of their liability through electronic cash cash ledger, and 99% of the liability through electronic credit ledger. If you see their total liability is 6 crores 25 lakhs. 6 crores 25 lakhs is their total liability. Okay. Out of this, how much credit can be utilized? Only 99% of the credit can be utilized. So they cannot utilize the entire amount. So which means 6 crores 25 lakhs into, so 99%. So that will be what? 6 crores 18 lakhs 75,000 can be used. So what is the remaining amount? 6 lakhs 25,000 is the balance which is payable through cash ledger, but they have sufficient balance in cash ledger. Now what is the revised balance in credit ledger? 7.5 crores minus 6 crores 18 lakhs 75,000, that is the revised balance in credit ledger, and cash ledger 75 lakhs minus 6 lakh 25, that is the revised balance in the cash ledger. So this is how they need to make the payment. Then also state the nature of documents on the basis of which ITs would have been taken. So as per rule 36 sub rule 1, 5 documents: tax invoice given by supplier to recipient, tax invoice given by recipient to supplier in case of RCM supplier is unregistered, and then debit note, input service distributor invoice, and bill of entry. These are the 5 documents on the basis of which ITC can be availed. So maybe what students would have done is that they would have answered only this first part, second part they would have missed, for which they will lose the marks. So they have clubbed these 2 questions for 5 marks. Then last case study 5. I don't think so. I don't know which case studies you will be answering, etc. in exam, but The indirect tax portion in all these case studies I wanted to discuss, so that's why I'm sharing this with you. And in this, there is one issue. This issue is related to, goods sent on some import of machinery and then it has been sent. So say this, there are two issues pertaining to this, two paragraphs. So I'm just reading this first paragraph. REL, in order to improve production efficiency, imported machinery valuing 1.150 lakhs in June 2023 from Japan, on which import duty at the rate of 15% was paid. Machinery was used in the factory to produce rail coach components for sale. After the installation of new machinery, no changes in the product price were made. So they are telling, so they have imported a machinery, they paid customs duty 15% and they used it, but there is no change in the price of the product. Okay, so this, there is no change in the price of the product is something which is actually crucial here. I'll tell you why later. When the statutory auditor were carrying out the audit in March 2024, they observed this transaction of import of machinery and were of the view that import duty was payable at the rate of 12.5, not 15. So actually they have to pay 12.5, but they paid unnecessarily 15% as a customs duty. And they took a second opinion, and even that second opinion confirmed that the view of the statutory auditors, they need to pay only 12.5%. So what they did, they made a refund application. They filed a claim in March 2024 for refund of excess input tax paid, for the excess import duty paid. However, the refund claim was rejected by the customs authorities. Now, whether the question is whether the customs authorities can reject the refund claim. Okay, actually here in customs, when you are making the refund application as per section 27 of Customs Act 1962, we need to prove that there is no unjust enrichment. We need to prove that we have not transferred the burden to the next person. And actually this question is prepared, this issue is prepared based on one case law, SRF Limited, like that one case is there. Okay, so what I did, I have shared the entire, case law summary, customs case law summary in the Telegram group. You don't know, like I have typed it because previously it was already there in the video, but students felt, sir, we need something quickly to just go through. So for that reason, I have typed on the day, you won't believe, on the day I sat, typed everything and I have posted. So this SRF Limited case you can see. So in this I have given customs duty paid in excess of import of capital goods, the price of finished goods remains the same. That's what I told you, that issue. So the price of the goods remains the same before and after import of capital goods, whether refund is subject to unjust enrichment. So here they are telling that yes, doctrine of unjust enrichment is applicable because even the incidence of duty can be passed directly or indirectly. So whenever the capital goods are used in manufacture, the duty paid on their import will go into the costing of the goods manufactured and sold and can be passed on to the buyer. So price, just because the price is same does not mean the burden is not transferred. So there could be multiple factors. Uniformity in price before and after assessment does not lead to inevitable conclusion that duty burden has not been passed. We cannot conclude that way. So therefore, applying that only, they created this question. And see the first one MCQ related to this, whether the rejection of refund of import duty by customs authorities is correct. Rejection is not justified. No, it is justified. Rejection is justified as machinery is used for manufacture of goods and the duty paid on import of machinery has gone into the costing of the goods manufactured and sold and thus passed on to the buyers. The principle of unjust enrichment will apply. That's what literally that case law, SRF Limited case law, they converted into one question and they have asked. Okay, then sir, why not point number D as the period of claim? Actually, what is the time limit for making application for refund? So we need to make refund claim within 1 year under customs, but here it is within 1 year because they made a claim in March 2024, they imported in June 2023. It is within the time limit. There is no breach of time limit condition in this case. Okay, this is a 2-mark question. Then another paragraph say this, this is also for one MCQ. REL imported one steel cutting machine on 1/3/2021 which required some customization. REL identified that for customization of such machines, authorized dealer was JB Enterprises, who will carry out the necessary modifications. REL sent the machinery directly from the port to JB Enterprises for job work and the same was received by JB Enterprise on 6/3. Company has also sent molds and dies having total invoice value of 94,400 on 2/3 and was received by JB Enterprise on 5/3. Machinery was received back on 4/3 and molds and dies not received till 31/3/2024. These on goods sent on job work. So if any goods are sent on job work, it should be received back within 1 year in case of processed goods, and if it is capital goods within 3 years. But what should be taken as the date? Suppose if we are dispatching from the principal's place, the date of dispatch should be taken as a starting point. If the goods are directly delivered to the job worker's place from the supplier's place, okay, principal supplier's place to the job worker's place, then in that case the date of receipt by the job worker should be taken. But if you see here in the first two lines itself, it is given directly from the import port we have sent it to the job worker. So what is the date of receipt by the job worker? So the date of receipt by the job worker is 6/3/2021, and the machinery is received back in the factory of the principal by 4/3, means is it within 4/3/2024? Is it within 3 years? Yes, it is within 3 years. So the machinery is received back within 3 years, and we don't have to pay, deem it as supply. If the machine is not received within 3 years, then it will be deemed as supply at the time when it is received by the job worker in the hands of the principal. Okay, so but we don't have to do anything for machinery. For molds and dies, this time limit is not applicable, because for molds and dies, jigs and fixtures and tools which are sent for job work, this time limit is not applicable. So it can be received after any time period. The deemed supply will not come. So this is actually section 19 read with section 143 of CGST Act, job work provisions. And here what they are telling is that which of the following statements, in light of the provisions of GST and rules made thereunder, consider the following statements. Machinery has been received back by REL within the stipulated time, hence it will not become supply. True, that's a true statement. Machinery has not been received within the stipulated time. False, they have received it. Molds and dies not received back within the stipulated time. Yes, but it will be deemed as supply. False, it will not be deemed as supply, because the time limit is not applicable in case of molds and dies. Details of challan in respect of machinery received from JB Enterprise is required to be reported to be furnished for the half year October to March by 25th of April. So they need to submit the details of goods sent on job work and received from job work. So by 25th of the month following every half year, that is correct, only October to March. But you know where they kept the twist? In the form number they kept the twist. Actually the form number is ITZ4. Goods sent on job work and goods received from job work, the form number is ITZ4. Many students will ask me, sir, why are you telling form numbers and all? For this only, for this only, for this only. So many times students will ask, should we learn all these things? No, learn, nah? Learn. What else you have? Learn. When you are learning, learn completely. So you don't know where it will be useful. If not useful in paper 5, it will be useful in paper 6, na? IBS paper. See this. So now if you remember the time limit and go, time limit is perfect, pakka, and they have kept the twist here. So that is ITZ3, wrong. ITZ3 is wrong. It should be ITZ4. So therefore it is a false. Now people will sit there in the exam hall and they will scratch their head. Everything is correct only now. So which is the correct option, like that? Okay. So therefore option D, 2, 3 and 4 is the correct answer. They are asking which of the above statements is not correct, means false statements. So 2, 3 and 4 is the false statement. So option D is the answer. So these are the questions, and we don't have any descriptive question related to indirect taxes. But indirect tax is the easiest paper in 5 papers, actually speaking. Okay, I'll say fourth easy paper, then audit, FR, AFM, DT, then IDT, and then audit, to be frank with you. Okay, so with due respect, audit is also difficult. Okay, fine, equal of indirect taxes. I am making like polite, I am being modest. But audit is something which is theory, we can cope up with that compared to indirect taxes. That's why I said this way. If this indirect tax questions itself is of this much intensity they are asking an IBS, then you can think of, I can even imagine the other subjects, because I have not gone through fully. So, but other subjects, what glance when I made, it was not that easy. So lot of twists were there. And one question I was reading about intangibles, how to do reporting, and they are asking like we need to put the conditions for derecognition. Then one more question related to TPM. So total productive maintenance, whether it is industry standard, actually we need to compute the OEE and all, overall efficiency ratio. Okay, so that ratio and all we need to compute by availability ratio and then productivity and usage ratio, like that. So actually speaking, paper is difficult. This IBS paper is very, very difficult. Now if you are appearing for May 25 exam and watching this video, definitely this is a eye opener, wherein in indirect tax itself it is like this and other parts also like this. So my suggestion is to put more and more efforts. It's not about the lectures, it's about all the subjects what you're learning, properly learn and carry the books properly, so that there the time will not be sufficient. You should create the weapons ready. That's what I felt. Okay, done. And yes, all the very best for your forthcoming exams. And those who appeared for November 24, don't worry after seeing all these answers. So nothing is in your hand beyond this. Already you have given your best, so nothing is in your hands, just pray for the best. But I can say one word out of all these things, like ICI has proved its standard. ICA has proved its standard. Amazing question paper, actually speaking. So a teacher, as a teacher, I can enjoy, solving these questions and all. Superb it was. It was like completely testing the knowledge. But from the student point of view, yes, we have to increase our standard in this. Maybe many people would have commented ICI that you're making course easy and like that. So that would have touched their ego. So that's why they are making it like this. I feel so. So yes, yeah, all the best for your forthcoming exam, May 25 exam. If you are appearing for May 25, those who appeared for November 24, hope for the best, fingers crossed, and definitely positive things will happen. Don't worry about that, don't give up. Okay, thank you, signing off.